Welcome to Compass Global Markets Weekly Update. I'm Tony Boyajian. In the world of foreign exchange, we expect a weaker US dollar to prevail this week, primarily on the back of four reasons. The first one is the softer than expected first quarter GDP outcome in the US. Growth there was only 0.7% against forecasts of 1.2%. It's the weakest pace in 3 years. Consumer spending has been weak, but it must be said that investment growth has been strong. Secondly, US durable goods and US consumer confidence numbers were a little bit low, they were less than expected. Thirdly, the FOMC, the US Federal Reserve's monthly board meeting, takes place this Thursday. We expect them to leave official interest rates unchanged in that 0.75 to 1% threshold. The Fed's pace of interest rate hikes, what they call the normalization process, will remain gradual. And the last reason why we believe the US dollar will remain weak this week is that the US tax reform proposal looks like it's going to linger. It'll probably not be ready till about June or July this year. The market is currently pricing a 70% probability of a 0.25% rate hike in June this year. But we believe they will wait until September because falling bond yields don't augur well for a strong economy. In other words, we've seen slow US economic growth. It looks like they won't raise rates when the economy is slowing. Last week we saw the Trump administration make some tax plans in the US. Now this includes reducing the personal income tax brackets from 7 tiers down to 3. It also looked at cutting the corporate tax rate from 35% to 15% and also proposing a one-off 10% tax on earnings of offshore companies. There's about $1.5 trillion US dollars sitting outside in foreign countries for big US companies like Microsoft, Apple, Pfizer and IBM. And if that gets repatriated back to the US, it's going to strengthen the US dollar over time. We believe the negotiations between the Trump administration and the House Republican Party, yes, they do have different views on the tax plans. We believe this will drag on for some time. It will probably keep US rates on hold for the next few months. However, once these measures abate, then assuming no major changes take place in the tax plans, and we see the US dollar strengthening over the course of the second half of this year, and we could see the US dollar put on another 10% on the upside, and interest rate rises will be back on the agenda. We expect the Aussie dollar to firm even further this week. We've already seen some short covering. Aussie dollar has moved from 74.5 US cents to 75.5 US cents. It has the potential to get back up towards 76 cents this week. We believe it'll stay firm because another 4 reasons for that. A, we believe the RBA will leave official interest rates unchanged today at a record low of 1.5%. And that decision is out at 2:30 p.m. Sydney time. We also expect them to reinforce their neutral monetary policy stance. Secondly, first quarter CPI numbers were below expectations at 0.5%. Annualised inflation in Australia is 1.5%. It's well below the RBA's target of 2 to 3%. Thirdly, we've seen strong Chinese economic activity in recent days. The manufacturing PMI is still above that 50 level, which indicates that the economy is expanding, and that augurs well for the Aussie dollar. And lastly, the RBA's statement on monetary policy is out on Friday. It looks like they will revise their 2017 GDP forecast higher. Improving world economic conditions is supportive for the Aussie dollar because the Australian dollar is obviously sensitive to the commodity exposure that it enjoys. Meanwhile, we've got Australia's federal budget handed down next Tuesday on the 9th of May. Treasurer Scott Morrison has already flagged housing affordability to be the main theme of the budget. One proposal being considered is reducing or limiting the number of properties that one can negatively gear. This means that rental rates in Australia will probably increase over the next few months. Elsewhere, the French presidential election takes place this Sunday on the 7th of May. It's the first time since World War II that the Socialists or Republican parties won't be challenging for the French leadership. The markets at the moment are underpricing a Marine Le Pen victory, which is the far-right candidate. Current polls indicate that the 39-year-old independent centrist Emmanuel Macron will win the election by 60-40% split. But considering that the younger generation of French voters are disenchanted with youth unemployment levels above 25% and also unhappy with, well, basically they want solidarity. We could see a Brexit type or a Donald versus Hillary type shock in the market. If that was to occur, look for a sharp fall in the euro. Elsewhere, look, major economic data this week. We've got the March trade balance in Australia out on Thursday. As I mentioned, RBA Governor Lowe speaks in Queensland on Thursday. We've got the RBA statement on monetary policy on Friday. In the US, we've got the FOMC meeting on Thursday, followed by the all-important jobs numbers, the non-farm payrolls on Friday. Compass Global Markets, I'm Tony Boyadjian.